So many times we implement a strategy or buy a trading bot with an unbelievable backtest result, 1000% return in only 6 months. Then quickly we get carried away and thinking of quitting our job or buying that Lambo. But once we put real money into it, things go from rosy to sour. In today's video, I'll show you the backtest result of one of my trading bots with unbelievable and great return. Then we go through a detailed process to see should we trust this or we should walk away and not even put a cent in it. This is artificial intelligence for trading, and let's delve into it. Over this video, I'll show you 5 categories of must-have criteria to evaluate your trading bot or any backtest result. Also, the metrics to measure those criteria. As a bonus point, I'll take you through a Python package that can do all of those metrics and criteria in just few lines of code. First, the assumption on backtesting, meaning what exactly is considered as return. It will be super quick as backtesting methods are not focus of this video. Then we go to my trading bot with the backtest result. It has impressive return on backtest, roughly 1000%. We assess it from different angles. I'll be talking what needs to be measured and what metric can help us measuring it. Then, as bonus point, I'll introduce a Python package that can do all in one go for you. Basically, the result of any trading bot is return, meaning the percentage change of a price movement of an asset when you have the position. In this exercise, it is based on daily return, meaning no matter how many trades it made, no matter if it keeps the position overnight or not, end of the day, I calculated how much returns it generated daily. We need to measure 2 things, basically answering 2 questions. Is return good overall during a period? How good is it on average? The second question is in respect to its volatility, meaning if returns fluctuate, how good it was. How do we know if return is good overall during the period? It's easy, probably you already used it. It is called cumulative return. It basically says how much return I get if I start from a specific time and finish in another time. Example, I start from $60 capital and end up with 80. You just calculate the percentage change, which is roughly 30% here. Be careful. It could be deceitful. If I keep changing periods, it shows different values. Also, it doesn't say much about what happened in between. Then, if cumulative return is sensitive to period, how to see if it is good on average? Let's say on average monthly, how good it was. You can average the return. It's called compound annual growth rate, or cVar for short. The original definition is on year, but here I use it monthly. The concept is the same. Basically, your average return every year or month. Let's say I start on Feb with $60 capital and finish in October with $100. It is 9-month period. cVar formula is end value divided by beginning value with the power of inverse of t. T is the period count. So we end with $100 and started with $60 over 6 months, which is 10%. It means on every month 10% return. Don't forget, the return is not arithmetic series, but geometric ones, meaning every item, every value keeps multiplying to the previous number. Basically, if your return fluctuates, it is smoothed out and it gives you some average. Now, second question, in respect to its volatility, meaning if returns fluctuates, how good it is, how we can judge the return. First, we need to understand how to calculate fluctuation and volatility. Let's say these are my returns on different days. It varies from -20% to 60% and mostly 20%, meaning average of 20%. Now, compare it with some other set of returns. It is mostly -20% and plus 60%, and not much in between. And guess what? The average is the same. Difference is second one has higher standard deviation, meaning values are far away from their average. It is a good indication how much you can trust average. Now we understand volatility. Let's talk about another indicator to incorporate volatility in our return. It is called Sharpe ratio. Basically, it divides the average return by volatility. Let's see how it helps. Let's say I have a good return with crazy volatility. It means return is really high. That means higher standard deviation, and it results in less Sharpe ratio. Basically, it cancels out or weakens the importance of good return by volatility. What if my returns, which has high standard deviation, have some fluctuations on positive side? Then it is good. I shouldn't cancel the good and positive return by standard deviation as Sharpe ratio does, because it is on the positive side. Basically, I should be worried on the left side, not on the right side, meaning on the negative side. Then Sortino comes into picture. It only counts for volatility on negative side and ignore the positive side. This section is answering how risky it is. We might get margin call in some scenarios and can't continue. Also, we might get emotional based on your personality and think it doesn't work, that the strategy doesn't work. We should change this strategy. Or is it kind of expected, this kind of behavior? Basically, what we want to know, what do we subscribe to? Let's go back to our cumulative return. Have a closer look on this part. During this part, the capital went down and it didn't come back up for certain period. We can draw this diagram different way, meaning all the places that it was negative returns and took some time to come back up to zero. It is called DrawDowns. Basically, negative returns over some period. Now, what is the worst day? It is called max drawdown. Basically, the max negative return, the lowest amount that your capital can go down. Keep in mind, in all of these, your returns might have great return and Sortino ratio overall, but in worst day, it can lose 90% of your portfolio. Now, to make it more formal, there is a metric called cVar ratio. Basically, it says cumulative returns but divided by max drawdown, meaning it cancels out your return when there is a big max drawdown. Now, let's look at drawdown from different angle. Let's say, okay, you're happy if 40% of your portfolio is gone, then you need to ask how long it takes to come back up to the same place. Basically, duration of being underwater. Again, your mentality. Are you happy to keep losing money for 6 months and still not breaking even? Different metrics to consider this criteria. We can have longest drawdown days. You can have average drawdown days. Let's make it a bit more formal and look at it holistically instead of different metrics. It is my return. I can draw a continuous graph on it. It is called probability distribution of my return. As you can see on the hump of this bell shape, most of my returns are there, meaning higher probability that my return is around 0.2. That probability curve can have different forms. All of these three have the same average, which is around 0.2. But yellow one is really stretched and blue one is not. It says for yellow one, even though average return is 0.2, but other values are also likely. If you remember, it means higher standard deviation. To measure this, there is a metric called kurtosis. Lower, the better, because you can trust the average return better. Basically, it lowers than 3, it is good. Please have a closer look at these three return probability distribution. As you can see, amber and yellow one are not symmetric. It means even though the average is still 0.2, but one side has more probabilities. If symmetric, meaning the chance of both sides are the same. To measure it, there is a metric called skew. If more than or below 0, it is more likely to lean towards one side. And if it is 0, it means perfectly symmetric. Now, let's look at it from a different angle. What if I put my money in the same period that using my trading bot in the bank and do nothing? Do I get more return or similar return? The second question is, does my trading bot do over trading or under trading? Does it hold an asset for too long, which is a big risk? Let's say we sweat and do all these research to get some return, but I can get some risk-free assets. Here is US Treasury bond return, which has basically no risk or minimum risk. And here is my trading bot return. If my trading bot cannot make more return than risk-free asset, then my trading bot is not worth it. If I tell you I have a trading bot that does 100 trades per day, are you concerned? Of course, yes. Swapping assets comes with commission. Also, not always we get what we want based on the market. Or if I tell you I have a trading bot that did only one trade in the whole year, it keeps asset for so long. Let's say you are a day trader in Forex and keep your position for 2 weeks. It's dangerous. So there is a metric called time in the market. If it is too big or small percentage based on your trading style, it can be concerning. The question is how to avoid margin call and how to measure the chance of it. On every trade or every day, because we don't know what will happen, we want to risk small portion of our portfolio. What if you get margin call and you cannot continue? Let's say the trading bot every day risk, 50% of my portfolio. Do you trust it? Of course not. Even though in the back test it comes out clean, but it is crazy and too risky. Let's say it is all of my negative returns. How much money I would be sure that I would lose more than? So we should see where 90% of my losses. As you can see, mostly not worse than 30%. The calculation of 90% that I just showed you is called value at risk, or VAR for short. Now, again, here is all of my negative returns. We talked about this part, but how bad is the extreme worst scenarios? Here is 40%, but what if it was 90%? For that, we have a metric which average all of those big losses. It is called expected shortfall, or cVar. If too high, it means in extreme cases, chances are we get margin call and get wiped out. So how do we know how much should we risk on each trade to survive? What percentage of our capital gain given a strategy? Let's say I divide my capital into 6 equal parts, and every time I trade that much. If I'm on a streak of loss bigger than 6 times, then I get wiped out and not there to see good returns, if any. So should I make it smaller? If so, then how small? If it is too small, then it damages my return, because even if I have good trades, but I don't get enough return compared to my capital size because the trade is too small. It is where Criterion can help. R is the win to loss ratio and W is winning rate. I don't get into the details of why this formula works, but you can use it to see if you risk too much or too little given your strategy. Now, 2 more questions. How to compare good days or trades with bad days on average? Is the success of cumulative return is because of few crazy outlier trades, aka fluke, or actually doing something consistently. Well, again, here's my returns divided into positive and negative. I want to know how on average my positive and negative return is doing. So I calculated average of them separately and divide them. It is called payoff ratio. Average returns of winning trades by absolute of average returns of losing trade, because losing trade value is negative. It shows on average how good is winning trades compared to losing trades. If it is close to 1 or lower than 1, it means on average my losing trade is equal to winning trades, which is not good. Here again my returns. If I don't want to take into account the outliers to my average, then I have to exclude them because they pollute my average, meaning average on only 99th percentile of my return. So for that, we can use outlier win or loss ratio. If payoff ratio and outlier win and loss ratio too different, it means the return is mostly because of outliers, meaning like fluke. Now, if I want to know how extreme case is doing compared to normal cases, are they really different on average? I can average normal scenarios and divide it by average of extreme scenarios. 95th percentile of all returns by 5th percentile of all returns, which is called tail ratio. If really small, it means only extreme and rare cases do the heavy lifting, and big returns is because of them. We've gone through so many metrics and criteria and charts. Now it comes to my promise to take you through one of the Python packages that can do all in few lines. Here is the package. The name of the package is quantstats. As you can see, it shows all the metrics and even more metrics to evaluate your strategy. You need to first install it. You can do it through pip, conda, or whatever package manager that you have for your Python. Then you need to import the package. As you can see it here. With this, you can also download the assets. It is downloading Meta or Facebook. But also you can give your own trading bot results as return. As long as it is in pandas format, it works. Then by calling this function, it gives you all the metrics that we talked about in this video. For example, cVar, Sharpe ratio, Sortino, or DrawDowns, all of them for you in just one line of code. And also it shows you other charts. I strongly recommend to go through these charts and have a look around and see you can make a meaning out of these. I hope this video helped you to establish a process to thoroughly assess and validate your backtest result. If you find this content helpful, it means a lot to me if you can like or subscribe. Thanks for watching and chat later.